Welcome back, everyone in YouTube land. This is your tinfoil hat economist coming back to you at the speed of light with episode number 8, entitled Investing in the Age of Coronavirus. Well, today we turn our antenna to Washington in the District of Columbia, your nation's capital for Americans that are viewing. And the news flash is the House has passed a bill to address the coronavirus. And you heard it here first. It is a flop. Why do I say it's a flop? It does not have within it the one good idea President Donald Trump may have ever had, a national payroll tax holiday to extend to the end of the year. That would have been a $750 billion payroll tax cut or tax cut on average and working Americans and their employers. And the House Democrats decided they didn't like that. And what they went with was a lot of kind of rinky-dink band-aids, free coronavirus testing for everyone. That's a good idea. It doesn't stimulate the economy. 2 weeks of free sick leave and up to 3 months of free medical and parental leave. You'll have a big incentive to say that you're sick in the remainder of 2020. They're going to expand Medicare spending a little bit and a few other tchotchkes, but really nothing. The big whopper isn't there. Donald Trump's payroll tax cut is not in there. The only sliver of hope we have is that Donald Trump is said to be adamant about this. He really wants it. But this is a fine fettle we're in, friends. A fine fettle indeed, when the best macroeconomist in the entire United States is Donald Trump. Welcome to America, my friends. Welcome to America. So, going forward, what does this mean? Well, I think on March 16, when the markets reopen, I hope I'm wrong, I don't think the markets will go up in the following week. There's no news on a federal program to stimulate the economy. Meanwhile, the Federal Reserve will probably cut interest rates, might even cut them down to zero, or might get a bump from that. The problem is the Fed doesn't really have any ammo now. You can cut rates to zero. Rates are already very low, and that's good. They should cut rates to zero. They can engage in quantitative easing, which is the buying of bonds on globalized capital markets. May lower, relatively speaking, interest rates a little bit globally. How is that going to increase demand within the United States, or increase demand globally for that matter? What they need is helicopter drops, but they're not going to do helicopter drops. So, and what about gold, you ask? Gold is going down. Gold is going down, and I think it's because the largest gold markets in the world are not ETFs, they're not investors, they're not in America, they're not even the central banks of China and Russia. They are jewelry buyers, kind of an investment jewelry combo thing going on in India and China. Gold is often given as a gift, weddings, end of year, auspicious events. And I don't know if you'll see a lot of gold buying when people are afraid of coronavirus. The good news is China seems to have turned the corner. They seem to be leaving coronavirus, and I hope they do. So, my outlook is could have another down week on the Dow, S&P 500. You could have gold retreat again next week, which will start on March 16. So, this is your tinfoil hat economist signing off at the speed of light, and I look forward to meeting all of you again in episode number 9, when we will further investigate investing in the age of coronavirus.